sides to a really great financial future. Tom and Don are talking real money.
There's no point in you trying to do this stuff yourself. You don't know anything about managing money. You're just a bunch of people listening to a podcast. No, ladies and gentlemen, let me tell you, if you want to do this right, you need a professional. It's un-American to index. It is wrong. It is basically anti-capitalist, anti-American. It is a terrible thing. Active management only makes sense. It's going to make you more money in the long run. Or is it? Hi, everybody. It's Talking Real Money time. I'm Don. Over there is Tom. And we are going after that long-standing myth that we thought was put to bed a long time ago, that active management actually adds some sort of value to your portfolio.
Yeah, it's still a belief. I mean, because it's still something like half of the money in mutual funds and exchange traded funds is managed with traditional active management. I mean, it's still
and the
out
fact
there.
that we have to throw in traditional active management, that just confuses it.
Anyway, but pretty interesting new article from Larry Swedroe's Substack. He writes something every day, by the way. It's just remarkable, the amount. And I recommend Larry's work because if you want to dive into it, there's a place to dive into it. I mean, and he does this with regularity. So, and in this case, he looked at a study that examined 1,260 balanced mutual funds. Now, remember, a balanced mutual fund, the idea here is there's a trade-off between returns and risk inside the one fund, right? How much in stocks, how much in bonds. So you're making...
Generally, there's 60% stocks and 40%
bonds. Yeah, he gives you some variety here.
Yeah.
But yeah, generally, it's and I have from time to time told people that really don't want to do any of this, just go on the Vanguard Balanced Index Fund. It's okay. It's relatively cheap, relatively diversified. Not as much as we'd like to see you do, but it's okay. But here's a study that looked at 1,260 balanced funds managing $1.6 trillion in assets, and not just for a couple of years. This is 1990 through 2021, 32 years of data. And they looked at a variety of funds, right? They looked at all those funds, but they also looked at them in terms of aggressive, where you'd have 85% in equity, growth, which they say is 50 to 70% equity, the balance being in bonds. They compared them against, guess what, Don? Low-cost index funds portfolios.
Like the Vanguard Balanced Index.
Well, no, in this case, they used the S&P 500 and the Vanguard Total Bond. They actually had two.
Okay, that's an even
worse funds.
That's a worse comparison, but okay.
Yeah. So, and the results, this will not surprise you, but I hope it reinforces something you probably already know. Unequivocal, in Larry's words. Balanced mutual funds underperform simple index portfolios across virtually every metric. Let me say that another way. They lost big time, and it's not an insignificant number, especially, by the way, when you add in Sharpe ratio, Sortino ratio, sort of the risk-adjusted returns. And index portfolios also did better protecting on the downside, which is really at the end of the day what people want when they own a balanced fund, right? They don't want to see it go down as much as the market. But let me give you a few numbers. So they use $1,000 investment in January 1990. So if you're in 1,000 and you put it into kind of the moderate one you talked about, Don, 60% stocks, 40% bonds, right? That's kind of the traditional balance fund. In the active fund, your $1,000 grew to about $10,000 on average, okay? That was with the active, the traditional active, right?
Okay.
Then the simple index portfolio, again, we're remembering, in this case, it's the S&P 500 fund and the total bond, okay? Similar, 60-40. Your $1,000 grew to $15,000 in that period of time. I think that's 50% more. It's pretty significant.
I know, that's a big number.
It's a big, big difference.
Wow. Holy cow. So I was thinking that this was going to end up being from Spiva or something.
No, this is from a couple of researchers that dug into all those funds.
I mean, the Spiva differences generally on stock funds and bond funds tend to be a little bit smaller than that. That's a big number.
Yeah, and by the way, they say the average balanced fund in the study carried an expense ratio of 0.91. I didn't get a chance to look up what the Vanguard Balanced Index one, although they compare, again, to the Vanguard S&P 500 fund and the Vanguard Bond Fund, where they say you're looking at about 14 basis points. So far, far, far less. That is a huge difference in annual fees. But let me give you a few of Larry's takeaways, which I think are really good. Again, Larry Swedroe, Substack, talking here about this study of using traditional active balanced funds versus using two index funds. And of course, you have more control, right? You have lower costs, right? Because the control is yours. You can decide how you want to manage all this. But the downside, Don, and this is something we've talked about many times, is can you rebalance the portfolio, right? Mm-hmm. Because in this case, if you're doing one stock fund and one bond fund, stocks go up, bonds go down, whatever they don't move. You're going to have to sell stocks and buy bonds, oftentimes at a time when you just don't want to, because stocks are going up, and of course they're not going anywhere. They've gone. And that's a hard thing for many people to do, right? We've seen that repeatedly. So they recommend, by the way, that they say that 62% of 401k plans offer inadequate investment choices. Hey, that's an understatement. And poor performance are often added to the plans if affiliated with the plan trustee. Ha ha, right? I mean, guess what? They're going to put their own stuff in there. They also suggest that you look at target date funds. I wouldn't pay 90 basis points, 0.9, as they found here, for a target date fund. That is really expensive.
Well, I went and looked while you were going through those numbers at the American Funds Balanced Fund. And I looked at their Class C because that's really the only fair comparison, because Class A has a front load. So if you want to just look at pure annual fees, all in, the American Funds Balanced Fund.
Is it about a 60-40, something in that area?
Well, hold on.
I imagine it's something close.
Let me pull up the portfolio. That's a very good question, but I'm pretty sure that's where it's going to land. American Balanced Fund Class C's portfolio is, come on, load it. Look at that. It's 58-42.
Okay, so about 60% in stocks and 40%
really
in bonds,
close.
roughly.
That's really close. Now, bear in mind, it's from the American funds. Now, this is a big group. They can afford to be more competitive, you would think. They're sold through Edward Jones and lots of others. Probably one of the more respected, actively managed groups in America.
Absolutely.
I think that's fair to say.
Yep.
But remember, I'm using the C shares because the C shares are the more accurate way to do it. Because remember, they're always going to be broker sold, which means the broker's going to get a commission. So with the C shares, the broker still gets the commission, but then you see what the total annual costs they really think they are, including the commission. I'm dragging this out as long as I can to build tension. Because
you got me sitting on the edge of my seat here, man.
It's higher than I thought.
No.
For a simple balanced fund.
Yeah.
1.3.
Wow. That's just, in today's world, insanity comes to mind, crazy, out of this world. I mean, wow. That's
now, if we go to the Class A, which has a sales load of 5.75% up front, so you almost lose 6% of your money instantly. The expense ratio is 0.57.
Which
still
is better,
high.
But still, it's still pretty high.
But people look at the 0.57 and they forget what the commission being paid is going to do to their returns. It's going to drag them way down.
Yeah, do you know what the Vanguard Balanced Index Fund charges you?
It's like 0.8 or something, 8/100.
7/100. What we would call basis points. Yeah, it's pretty
7/100 of 1% versus 1.3%.
Which is something that doesn't get the attention it deserves, because right out of the gate, you got to do better than those other guys by that much to even get the return. So,
and one of the things that also we don't talk about enough is people say, well, if I hire an advisor, isn't that going to cost me 1% more than the fund? Well, you're hiring sort of an advisor when you buy an American funds through a broker and you're paying 1.3. I am pretty confident that none of our clients pay 1.3 all in, including our fee.
No, they don't, because the funds we use are very low expense. So to sum this up, which is, and I'm going to give you, I wouldn't do the S&P 500, as you know, and the bond. I would do a global market fund, an AVGE or DFAW, pardon me, that takes in a lot more stocks than 500, but you could still use a total bond and then rebalance between those two. But what Larry writes here at the end, I think, is really important. And this is something you've said many times, Don, so maybe he's listening. Sometimes in investing, as in life, the simplest solution is the best one.
No, actually, I'm going to modify. If I said that, it's always.
There you go.
Yeah.
2 index funds, periodically rebalanced. That's it. For people that want to do this on their own, very reasonable approach. So I think that's a powerful piece. I think it's worth reading. And again, I think it's worth heeding. And you should be paying attention because I think people buy those balanced index funds, think, it's great, I got it done. And then they leave it. They don't pay much attention to it moving forward.
And one other thing we have consistently said is that if you would take what Larry Swedroe and many other people who are academics in this field, if you take what we say and you follow it to the letter, in other words, you just simplify, even if it's so simple as just buying the Vanguard Balanced Index Fund, even that simple, you are likely to do better than you are with any of these complex strategies in aggregate. You'll always find the anecdotes where somebody's done better, but the research, the data keeps showing over and over and over and over and over again that just doing it boring, doing it cheap, wins almost all the time.
Yeah, and I mean, another thing with the traditional active is, right, these are people that are picking stocks, deciding on sectors, they're moving money around. And while they may seem like they're really smart people, I'm holding in my hand a stock certificate from a company called Enron. There's actual certificate. Somebody left this for me yesterday at the office.
Wait, look, can I see that?
It's really cool.
What a nice piece of paper. Look,
Beautiful.
They engraved
I know.
What is that? Who is that sitting in the
energy
throne
guy
there?
sitting up there with oil wells and the globe behind him, and it's
They
very
put some money into that thing.
Yeah, and sadly,
Oh, he's like a roughneck.
Yeah, thank you. He's got the hat on.
Oh, okay. My granddad used to look like that. He was a roughneck on the wells.
Good-looking fellow. But the problem is here, this is 82 shares issued in 1998, which is, I think we looked this up, the peak price for Enron was like $90 a share, something like
almost
that.
Almost $91 a share.
No. And that $91 a share times 82 is how much?
You don't have the math in front of you?
I didn't do that. Should have done this. Because when we do it on the fly, we always end up with egg numbers on our face. It's bad.
Let's just round it to $7,500.
$7,500. So this little piece of paper right here
was worth
28
literally
years ago.
That piece of paper. You could have handed that to someone, and they would have given you about $7,500 back.
Yeah,
minus a commission.
And
$7,500. Now, Tom.
No, then by 2001.
Yeah.
The shares went down to 25 cents.
Wait, okay, it still has value. Hey, that paper still at that point was worth $20.
Okay.
Okay, $20. What is that paper worth now? Open your desk drawer and pull out a piece of copier paper. Just slightly more than that. Slightly more.
And by the way, I have, as you probably already know, and I can remember where it is. It might still be in the home office. I have framed share of stock from Washington Mutual that somebody gave me, and now adding to the collection. I'm going to add the Enron share.
There's a moral, by the way, in this, in case you missed it. I know it was subtle. I know we're masters of subtlety. Understatement. We don't overstate anything on Talking Real Money. There's a message here about, I don't know, buying individual stocks. Enron was considered one of the best companies in America.
Innovative company, like 3 out of the last 4 years it existed.
Yeah.
Yeah.
Innovative in that they innovated their accounting system to fake numbers. But hey, and they fooled the accountants.
Yep.
Not just any accountant, not your neighborhood CPA. No. They fooled like Arthur Anderson, who isn't even alive anymore.
Yeah. So anyway, lesson I hope learned there. Okay, so with that in mind,
we need to
take some questions. Yeah.
Well, let's get to the first caller.
Okay, please.
Question, because that's that's where we like to start things off. Then we'll get to the Tom reading them. But let's take a caller.
We go to the phones, Houston, Texas, and Sean joins us. Hey, Sean.
Tom, how's it going?
Going very, very well. How can we help you today on Talking Real Money?
So I'm calling because I wanted to see about the potential option for my wife and I to pay off a 10-year HELOC that we've got right now. It's an additional loan we have in addition to our 30-year mortgage. So we were able to get a really good interest rate on our 30-year mortgage that we took out in 2021, got a 3.25% interest rate on that. But we did pull out a HELOC last year to help us with some pretty big home renovations. And we got about a 7.125 interest rate on that. And combined, if you look at the monthly payments on each of those mortgages, it's about $2,800 a month. So we're in pretty good financial standing in terms of our retirement and our savings and our investments. But we do have a brokerage account that's got about $90,000 in it. And we were wondering if it makes sense to potentially cash that out when that becomes sufficient enough to pay off the rest of this HELOC loan, which, like I said, it'd be paid off in 9 years, but and it's got about $100,000 balance on it. But didn't know if it made more sense to pay that off as soon as possible using those brokerage funds to free up some cash flow, or is it best to maybe leave that brokerage in, the way it is now and just continue to chip away at the 10-year HELOC and pay it off, according to the amortization table?
Yeah, this comes up a lot, especially for people a little older than you, but generally about their mortgage period. In other words, right, a lot of people want to get into retirement and be mortgage free, which I don't think that's a requirement, certainly. Some comes down to the interest rate, which is what concerns me here when you bring up the HELOC. The fact that the HELOC is at 7.1% interest, that's a number that is above the 5%. I usually say if debt is 5% or above, I really want to pay it off. It's over the long haul. It's hard for most investors to make more than 7% a year. It sounds easy because the market provides 10, but there's a lot of other factors there that sort of keep people from doing that. So in this case, yeah, I want to make sure I have my emergency fund in place. Sounds like you've done that. I want to make sure I'm saving for retirement. Sounds like you've done that. And none of this sounds like it's sort of outpacing your regular income. But because it's $100,000 at 7.1%, I probably would try to chunk that down as quickly as I can, because that's a little more expensive money than I like to see you sort of churning on that interest.
So you suggest maybe just making additional payments on it month to month and try to save some interest that way versus maybe depleting the brokerage account altogether at once.
Yeah, but if the brokerage account is not your emergency account, I probably would deplete it. In other words, because you're saving outside of that in your IRAs, that kind of thing for retirement, which is still a ways off, I probably would be inclined to take whatever cash I can get my hands on, if that's in the brokerage account, and use those securities to pay off something that has an interest rate of 7.1%.
Yeah. Yeah. And I figured that's, obviously that's the mathematical answer, but I just want to give a little more context around the brokerage account, and the intent behind it was also to be somewhat of a bridge account if I decided to step away from my breadwinning corporate job and maybe take a sabbatical, or if I stepped away and maybe had some kind of new endeavor that maybe a little bit more risky and less secure and uncertain than what I'm doing today before retirement age, right?
Yeah, that's reasonable. It doesn't have to be binary, right? You could take some of it and pay down that $100,000 line quickly and then have a plan for the next 2 or 3 years ahead of the 10-year and still have a certain amount set aside for something else that may be ahead.
Right. Yeah, and I am fortunate that the company I work for still offers a pension, so I've got a pension on top of these other things. So I guess I hadn't really factored that into my retirement planning, but I guess how do you guys typically look at that? I've kind of gone on the conservative side of pretending that it doesn't exist, but
Yeah, no, I mean, when you get down to a little closer to retirement, then obviously it becomes a huge part of sort of the retirement income part. But in terms of the investing side, I don't include it in, as some people might like, well, then I should consider that a bond, because here's why. Because then the fall of 2008 comes along again, right? Or the spring of 2000, where stocks really fall fast. And your portfolio goes down by 30% in a short period of time, which it did in COVID, did in 2008, et cetera. That's the part where I really think you need to think about how aggressive you want the portfolio design to be, because having a pension at that time doesn't really matter. It's going to be seeing those balances go down. It's going to be dealing with that on a regular daily basis. And it's going to be dealing with the pain, the emotional pain that comes with those declines. So I would take probably the risk quiz, which is available at talkingrealmoney.com. I would think hard about, do I need to have at least a little bit of fixed income in there to sort of balance things out before the next bear market comes along? But I would not consider the pension as part of the overall portfolio. No.
Yeah. Okay. Well, yeah, that's what I would do today. So that sounds pretty much in line. But yeah, appreciate the advice. I think I've got something to work with here.
Well, thank you for being part of the program. Thank you for listening, and thank you for reaching out to us. Hope we get to chat again.
Absolutely. Thanks for everything you guys do with the podcast. It's great.
There's that kind of question. And then if you go to Talking Real Money and you click on the Ask a Question button and you type in a question, some of them end up in Tom's grubby little hands right there and get read to you. So Tom's going to read us a question.
It is. I am. It's come from
I am. We might. I don't know.
Shelton, Washington. Ron writes us, I have several CDs. I'm assuming he's referring to certificates of deposit, not the musical recording device.
I have no more CDs. I got rid of all
I still have CDs, and I still play them.
No.
In fact, I was just thinking about what I'm going to play later today. I have several CDs, says Ron, but not making much. Should I buy gold or silver?
That is what? Come on, that's not a real question.
That's a real question. Really,
to replace CDs, should I buy gold or silver?
That's what he says.
Okay,
they're making a lot of money.
If you're smart about your CDs, you should be making on average with a CD ladder about 4% per year, which isn't nothing. It's not much, but remember, a CD ladder should be right at 100% safe if you're under 250. But
gold's up what? 50% in the last year, some ridiculous number.
Hallelujah for those who got in before.
Yeah, right. But the problem is they're all like Ron getting in now.
Yeah. Did Ron say how old he was?
He did not.
Okay.
No.
If Ron was born, like he's a baby boomer like us.
Yeah.
Then hopefully he'll remember that back in the 70s and early 80s, the same thing happened to gold. It ran up from about $35 an ounce to $800 an ounce, Ron. Don't you wish you'd gotten in back then when it was at 800 and just ridden it from there until today's 5,000 something, whatever it is? Tiny little problem there in the middle. From 1980 to 2000, talk about your CDs not making money. How would you have enjoyed losing money for 20 years straight? That's the flip side of gold or silver. They are speculative and they can plummet.
And they're only worth what the next person says. There's no value, there's no dividends, there's no interest, there's no growth. Well, maybe can you grow gold? I haven't tried it.
No, we've done that test. We
put it away.
We put them in the garden. We watered it. It didn't tarnish like the iron we put in the garden. But between the iron and the gold, the net increase was 0.
So if you're old enough to remember 1980 and think about that, and then old enough to remember 2000 and all those years in between, which actually I can remember a lot of those years because there were a lot of things that happened.
Vaguely. Some of them I don't remember as well as others.
That's a long time to wait to make money.
Yeah.
So
the answer to your question is no. Could it be that right now, this is 1980 again? Could it be?
Right.
Yes. Is it? I don't know. But could it be? Do you want to buy at the top and wait 20 years for it to come back? Oh, wait, it was more like 23 years for it to come back.
I don't know how if we've got the 23. We'll find out.
I don't.
It's a long time from now. So thank you. Great question. When you said, do you remember, I thought you were going to say, do you remember the Alamo? I was getting kind of nervous there for a minute because.
Well, you were just born then. So, it's only like people telling you about it in San Jacinto there.
I was hoping I'm on the right side.
That battle was when you were there with Sam Houston.
Sam Houston. All right. James writes us from Chandler, Arizona. Hi, Don and Tom. I love the podcast. Thank you for that. I'm still in the accumulation stage. I'm starting to think about my future withdrawal strategy. Sorry, I obliterated your question, but you get the point. I have a quick question regarding the 4% rule, which refers to taking out 4%. This is my add-on. Taking out 4% of your portfolio a year and not having it run out in
and
retirement.
Adjusting it for inflation.
Adjusting it for inflation. We've done this. And by the way, I think by the time you hear this, the retirement should now be up online. You should be able to go look at the videos where we talk about this. But if I am paying my wealth manager 1% annually, can I plan on spending 4% in addition to their fee, or does the 4% guideline typically include the management fee? Thank you for the helpful money advice. Best regards, James.
It's generally, most of the time, when you do these studies, these Monte Carlo studies that show that the 4% rule worked most of the time, they are based on past net returns after expenses. Because remember, let's say you're paying an advisor 1% per year, and the advisor is a good one who does very low-cost funds, your total expenses are 1.25 per year. Well, that's comparable to an active mutual fund, as we mentioned earlier. The American Balanced Fund is 1.3. So if it's gonna work with a balanced mutual fund at 1.3, then yeah, it's gonna work with an advisor at 1.25 total. And the other thing to remember, and this is not factored into the math, because you can't really factor it into the math because it's a nebulous number. But Vanguard has redone this study over and over again called their Advisor Alpha study. And their study finds that if you get a true fiduciary advisor, that 1% fee you pay has the potential and has proven in their studies to add up to 3% more than what you're paying every year to your returns.
Yeah, every year.
Because of it keeping you from doing dumb stuff, basically.
That's part of it. Fund selection, rebalancing, tax management, kind of all the things that a good advisor should be doing in addition to building that great portfolio. So
yes, a good advisor is worth the one, and we for our clients recommend withdrawal rates based on their situation with us, and that's the 1.2 or 1.2 something percent total in fees that they pay.
I hate to be rude, but I got to run because I got to get on eBay to see what I can get for this Enron stock certificate. So, because I think there's a lot of potential.
Gosh, now all of America wants to know.
Running to their computer to find out, what is Tom going to be able to retire now? Thanks to his recently. By the way, the guy who gave this to me, I got to call him because he may not have meant it to be a permanent gift.
Oh, dude, maybe not, because an Enron stock certificate actually has a pretty high value.
Uh-oh.
It's much higher than WorldCom. Oh, yeah, they're expensive.
Uh-oh, how much?
The lowest price one I can find is $225.
Wow. Okay. So I better take care of this.
Yeah, WorldCom's only $99.
How about Washington Mutual? I have one of those.
Oh, well, let's see. I bet no one even remembers what Washington Mutual was, except
unless you're one little part of Seattle, and you can remember that. Well, it was the largest trust bank in the world.
Okay, nobody knows the difference. So
yeah, that's a good point. But I like saying that because
Washington. There are none for sale. So
I think I've struck gold here, Don.
But I'm looking, and wow. How come there's no certificates for sale?
I thought Kerry Killinger might be selling them out of his basement or something. So
because that's where he printed them or something. No, not here.
Sorry, Kerry. No. All right. Well, no. I definitely, before I frame this, I'm gonna have to reach out to the party that gave it to me and say, is it mine to keep? Because they may want it back.
You better do that. That would be the nice thing to do.
$200 is $200.
Yeah, I was just surprised. It's still it's worth more than when it was publicly traded.
How do they say it? Worth more dead than alive or whatever
It's
it
worth
is?
more dead than alive.
There you go. So,
Oh, these are fascinating. Look at all these old, like a 1946 Globe
did you ever have any of
aircraft.
these when you had your map business or any of this stuff?
No, I
Any
never
of the
got into
railroad
this.
certificates or
Here's
I had a
a
railroad
certificate
one.
from Tucker,
yeah.
the car company.
Oh, I thought it was my dog.
No, the car company. Remember them?
Of
Tuckers,
course.
back in the
Great movie with Harrison Ford.
50s? Was it 50s or the
Yeah,
40s?
I think 50s. Yeah, right. Maybe 40s. Maybe late 40s.
Well, I'm
beautiful
looking at
car.
what else is out here. The Northern Railroad.
Oh, it's always the railroad stocks. Yeah, I had a bunch of those at one point. I don't know. what I did
Morenci
with them, so
Copper.
Don't remember them, but Northern
Flagstaff
Pacific.
View. Oh, this is the deal. I can get a Flagstaff Brewing stock certificate for $3.
And trade it in for half a pint or something, or what?
Well, thanks for being a part of our little get-together where we try to just talk about money, but we never can. We somehow always manage veering off into some bizarre direction. And maybe that's one of the things that makes it a good listen is that you just don't know where we're going to go.
Next week, stay tuned for, well, I don't know.
We
find
don't know.
out then.
See, we have no idea because we don't plan that far in advance.
In life or in the podcast. Either
Exactly.
way.
So, look at this. A
Found another
Donald
one?
J. Trump Media stock certificate. Trump Media. $149.
No offense to the president, but
It's got his picture on it.
I'll take the Enron one. So a little more.
No roughneck on that one. Just
No,
just
not even close.
just Donald. This is kind of, I'm enjoying this now.
Now you got a new hobby.
Oh, wow. I want that one. J. Paul Getty's signature on Mission Development Company stock.
How much is that one?
$145.
Well, you do have a big birthday coming up. Maybe you could ask somebody for it.
Studebaker Packard Corporation. $150. Oh, I'm just having more fun than I can stand. Montgomery Ward. Oh, come on. $26 for Montgomery Ward.
You used to work for Sears.
My mom used to work for Ward. She was the personnel manager for
Was she a
Montgomery
ward of the ward
nationally.
in that case?
Was she what? A ward of Ward?
Sorry.
God, you're
here all
funny.
week.
All right. Send your questions in at talkingrealmoney.com.
If you want help, ask us to.
Yeah,
Maybe
ask
we
us
need
for
your help. I don't know.
Yeah. If you're a psychiatrist or a licensed psychologist, call us for and help us, please.
There's a lifetime commitment right there. So good luck.
Go to talkingrealmoney.com again. Why? Because, well, if you do, you'll be joining us as we are talking real money.
The opinions and views expressed on this podcast were current on the date recorded.
Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone.
This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction.
Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor.
Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services.
Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.